Hi, everyone. We'll get the next presentation started. So earlier this morning, we heard from Dawn, Mark, and Amber as they shared their insights on the complexities of buying a business. As they alluded, it's now time to shift our focus to the other side of that transaction, the seller. Guiding the sale to a business requires experienced professionals, well-versed in complex tax matters, and equipped with the most accurate financial information. Our firm has the advantage of foresight, having assisted a multitude of clients across various industries to plan, manage, and execute a sale. So for the next 50 minutes, the discussion around selling a business will once again be led by Dawn, a partner in our tax services group, and Mark, a partner in our audit and assurance group, and also welcoming a new addition to the panel, Ryan Fronius, a senior manager in our tax services group with over 10 years of public accounting experience. So please join me in giving a warm welcome to our speakers, Dawn, Mark, and Ryan. Thank you.
All right, good morning again. This session will be largely focused on the sell side of transactions. And once again, I guess for the second time ever at the CPE Day, we'll have audit folks sharing the stage with tax folks. So this is a special day, the dark side and the light side. Before we shift gears, though, to really fully talking about the sell side, we promised in the earlier session that we would spend a little bit of time on purchase accounting, which is principally a buy-side issue, right? And so I'm going to talk about purchase accounting, and then we'll fully shift gears to the sell side. Okay, so when we start to think about purchase accounting, there's really a few high-level concepts I want to talk about first, and that's assets and liabilities should be measured at fair value. So you go in, you buy a company, and regardless of what those assets and liabilities are recorded at, on the books at the time you buy them, you are supposed to, for GAAP purposes, record those assets and liabilities at fair value when you purchase them. Now, practically, for working capital items, receivables, payables, inventory, oftentimes that's going to be the same value that they were on the books for on the seller's books. There can be variations, though. In the example that Amber and I talked about earlier, where our client bought a business and the inventory was, they were purchasing the inventory for much less than the sellers were purchasing inventory, they did have an adjustment to the value of the inventory. The inventory, as they put it on the books, was lower than where the sellers carried the inventory. But by and large, the working capital is generally going to stay pretty consistent with what the seller had it on the books for. But things like property, plant, and equipment, when you acquire that business, you're going to value that at fair value. A lot of times that's going to involve a write-up to the fixed assets. Depending on how much fixed assets you have, if that's significant, you're probably going to want to have that equipment appraised and written up to fair value based on the appraisal. You also need to consider intangible assets, and to the extent that there are intangible assets that are separable intangible assets, they're different than goodwill. Those intangible assets are also supposed to be recorded at fair value. And then finally, there can be contingent consideration in a deal, and to the extent that there's contingent consideration, that needs to be valued in conjunction with the transaction and recorded as a liability, again, at fair value based on your expectations for the payment of that contingent consideration in the future. The GAAP accounting is really the same whether you bought the stock or whether you bought the assets. But that's different for tax purposes, as Dawn has talked a little bit about. When you buy the stock of an entity, for tax purposes, really, you inherit the basis of the assets and the liabilities. So there can be a disconnect between book and tax. when you purchase the stock of an entity. There can be some differences in an asset deal, but they're generally less significant. The other thing that's important to remember in the purchase accounting is that any transaction costs that were incurred in conjunction with the transaction get expensed. There we go. Okay, a few other high-level notes before we dig into some examples. The excess of the purchase price over the net assets and liabilities is goodwill. So if we pay $10 million and we get $8 million of assets, the $2 million difference is going to go into goodwill, and that goodwill gets amortized over 10 years or less for GAAP purposes. And to the extent that you have a bargain purchase, let's say we paid $10 million and we got $12 million of assets, you're going to have a $2 million gain on that transaction. And under GAAP accounting, you actually will recognize a $2 million gain in the financial statements for that year. Again, some noteworthy book versus tax differences. On a stock deal, you're going to carry over the continued basis, as I mentioned. The transaction costs can, at times, be capitalized in a transaction deal and then get amortized over the period, I believe, a 15-year period. There are some instances where you are allowed to expense those transaction costs in year one, or a portion of them in year one, and Don and Ryan can tell you all the good details on that. And then intangible assets generally are getting amortized over a different period for tax purposes than for book purposes. So for goodwill, for example, that's getting amortized over 10 years for GAAP purposes and is getting amortized over 15 years for tax purposes. Let's look at an example. I have a few examples here. The first one here is a transaction where there was a $12 million purchase price, which exceeds the fair value of the acquired assets and liabilities. Several things to notice on this slide include there is, you can see the leftmost column is the closing balance sheet, as reported by the seller. The next column is excluded assets. So in this deal, there were some assets that were excluded from the deal. Like most deals, most asset deals, the cash did not come over. So the cash is excluded. In this case, there were also some prepaid expenses that were excluded, and there were some accrued expenses that were paid by the buyer instead of the seller, and those were excluded. Then we have a column for the purchase accounting, and the purchase accounting adjustments ultimately resulting in the open balance sheet on the far right. So in this example, the receivables, the inventories, the prepaid expenses, they were all carried over at cost, which was determined to be representative of fair value in this transaction. The value, you can see that the value of the property, plant, and equipment was almost $1.8 million on the closing balance sheet and was written up to $2.4 million in the opening balance sheet as a result of an appraisal that was performed. In this case, the purchase price was funded with $8.25 million of debt and $4 million of equity. Transaction costs of $150,000 were incurred and were expensed. This essentially shows on the balance sheet as a day one reduction to equity. And then debt issuance costs of $250,000 were incurred and served to reduce the reported debt balance. So essentially, we borrowed $8.25 million, $250,000 of that was debt issuance costs, and the net value assigned to debt is $8 million in these financial statements. That's kind of a base level base level example. As we move to the second example, before we move to the second example, let's look at the goodwill. So there is goodwill recorded in conjunction with this transaction. That's calculated as the $12 million purchase price plus the liabilities that were assumed of $1,073,000 minus the value that was assigned to the current assets of $7,432,000, and then minus the value that was assigned to the property, plant, and equipment at 2.4, left us goodwill of $3,241,000. Moving now to example 2. Example 2 will look very familiar, a lot of the same facts here. The difference being that the purchase price was changed. Now, instead of purchasing the purchase price being $12 million, the purchase price was $6 million. As a result, there's no goodwill reflected in this example, and instead, there's a gain. And this slide shows the calculation of the gain. We had a $6 million purchase price minus the liabilities assumed, or plus the liabilities assumed, minus the value assigned to current assets, minus the value assigned to property, plant, and equipment, gives us a gain on the transaction of almost $2.8 million. And again, for reporting purposes here, that's showing as that's flowing through the equity line. On your P&L, you would actually have a line item for the gain on the bargain purchase. And then we have a third example, and in this example, it's very similar to the second example, but the first two examples did not contemplate a working capital settlement. Remember, we talked about working capital settlements in the first session. To the extent that the actual working capital that's delivered on the closing date is different than the target working capital that's outlined in the purchase agreement, you can have a working capital settlement. So in this example, there's a receivable recorded because the working capital delivered was $6,359,000, and that was less than the target of $6.5 million. And so you can see there's $141,000 reflected on the balance sheet for a working capital receivable. We're going to get additional money from the seller because they did not deliver enough working capital. This example also considers some contingent consideration. The purchase agreement was structured so that the buyer would pay the seller additional consideration equal to 10% of annual revenues for each of the 3 years following the closing. And management estimated that the present value of that obligation was $1,950,000, which served to increase the purchase price, above the $6 million base purchase price, and was recorded as a liability. So some of the calculations are shown on this slide. $6 million base purchase price plus the contingent consideration of $1,950,000 minus the working capital settlement gives us a purchase price of just over $7.8 million, plus the liabilities assumed, minus the current assets, minus the fixed assets, gives us a gain in this case of $950,000, which again is rolling through the beginning equity. So there's a number of different things that can happen in the purchase accounting, and as we talked about earlier, this kind of covers some of the mechanics of the purchase accounting and some of the different things you can run across, but this is really important because this serves kind of as the basis for the beginning of the company's operations, and to the extent you don't get this right, that can flow through the P&L afterwards and can misstate the earnings after the transaction closes. So now we're going to, now that we've taken a little bit of time to look at the purchase accounting and the mechanics of the purchase accounting, we're going to shift gears to really purely talking about the sell side. And I have a few closing thoughts from my perspective, and then we're going to turn it over to the dark side. And John mentioned that our firm now has about 100 employees. We're all headquartered downtown Pittsburgh. But we want you to know that, our ability to do diligence extends well beyond the Pittsburgh area. After I was at GYF for a few years, probably 4 or 5 years into my career, I started doing a fair amount of private equity work, and gave me the opportunity to see a lot of part of the country I never thought I'd see. Some of you may remember that a few years ago I listed during my presentation some of my favorite barbecue spots, and those mostly came from trips to do due diligence assignments, whether that be in Texas, in Alabama, in Tennessee, in Michigan. We have clients all over the country, ranging from coast to coast, ranging from Michigan to Texas. So if you're looking at an acquisition, if somebody is looking at an acquisition, we're able to cover really the whole range of the country relative to diligence. We will go there and visit. We will do some work on site. We're also able to do some of that work remotely. And we'll probably check out some barbecue spots while we're there, because really what else is there to do in Beaumont, Texas? So as we transition to the sell side, we're going to cover mostly tax-oriented topics on the sell side, but one thing that I wanted to mention about the sell side from an accounting and reporting perspective, from a valuation perspective, is we want to encourage folks that are looking to sell their business to really engage our firm sooner rather than later. You really don't want to wait until 6 months before your transaction to start working with a firm that can help you. A better way might be 3 years to 5 years out, because if you have a business that maybe accounting hasn't been your number one priority, when you go through the diligence process, they're going to see that, and that's going to hurt the value of your business in the transaction. And so they're going to see some uncertainty there, and it's going to hurt the value in the transaction. So it's helpful to work with a firm that can help you from a planning perspective, both relative to tax planning, but also relative to having your books in good shape, making sure that you have good reported numbers for net income, good reported numbers for EBITDA, understanding what your EBITDA adjustments are. There may be some non-recurring things that have happened in the 3 years leading up to the deal. You want to have those identified and laid out so that, like the example Amber pulled up earlier, where she showed the reported EBITDA and then she showed a number of seller-identified add-backs. It's good to have those identified before the buyer comes in and does their diligence, so that you can say, hey, here's what we've reported. There's a number of non-recurring items in there, and those need to be considered when we talk about the value of this business. So really encourage you to think about, if you're going to sell the business, to start thinking about the accounting 3 to 5 years ahead of time. We can certainly help you with that as we do an audit or a review. We can help keep track of where EBITDA is on a year-to-year basis, inclusive of add-backs. If you don't think that far ahead, we can also do some buy-side diligence, and that's helpful when you're a seller, to have somebody come in and do some buy-side diligence and identify some of the things that the seller might identify in diligence, so that you're kind of prepared to answer their questions. We can help identify any skeletons that are in the closet that the buyer might be asking about. So that's helpful from an issues identification perspective, and it's helpful in kind of training your team as to how to respond to some of those things too. So please, if you're looking to sell your business, please consider starting early, and consider using somebody to do some sell-side diligence for you too. With that, I'm going to turn it over to Ryan for what I expect will be an excellent tax talk.
Thank you, Mark. Although you brought up barbecue twice, so I don't know if I'm going to be able to concentrate during this. All right, so let's transition away from the accounting side of things and look more at the pure, specific items and tax issues related to selling your business. The first thing, getting paid. Obviously, that's number one. Why else would we be selling our business? We want to get paid for our business. The contract price really is completely irrelevant if you're not going to get paid, whether that's through an earn-out that you don't receive later on or whatever. So we always say, jokingly but not jokingly, be happy with what you get on day one because you might not ever see a penny again. Legal issues. We talked about this a little bit on the buy side earlier. There's always legal issues that pop up. So make sure you understand what it is that you are selling and understand the risks and exposures of that sale. Understand who's on the hook for the liabilities, whether they carry over to the buyer, whether they remain with the seller. You don't want to think you're walking away from those liabilities when in reality, you're not. Generally, the seller is off the hook in a stock sale, whereas in an asset sale, that might not be the case. Again, this is generally. And a lot of things we're going to talk about are general terms and things that generally happen, but really, you need to look at the agreement because there can be specific items in that agreement, whether it's an asset sale or a stock sale, that dictate the terms of the transaction. The distribution of the transaction cash. This is a huge thing to consider in a transaction. And this, Mark's talking about getting us involved as early as possible in the process, whether it's us, another CPA firm. Make sure the deal team's working with the best advisors possible and the best CPAs to make sure that you're not over-distributing that transaction cash. We'll get into this a little bit more detail later on, but you'll see that you think you sell your business, you think it's over. That's not always the case, whether there's tax returns still required to be filed in future years, whether there's non-resident state taxes. Always keep an eye out for that because you don't want to run into tax landmines, we'll call them, and have a huge surprise after you distribute that cash. And then the tax issues, of course, is what we'll be focusing on. What am I selling? Am I selling stock? Am I selling assets? How will I be taxed? And who's going to retain control of the legal entity after the sale? All right, so when we look at this, we're going to be looking at this a lot in terms of how things line up as far as stock sales versus asset sales. And remember, we're looking at it from the sales side perspective. There's different ways you can structure your business. And depending on how you structure it can have significant tax implications down the line. As we talked about earlier, generally the buyer wants an asset sale. Well, why is that? One of the biggest reasons is because when the buyer purchases the assets, they get to step that up to fair market value, and depending on if there's significant depreciable assets, they could get some significant immediate tax deductions right off the bat. The seller, on the other hand, generally, they want a stock deal or an equity deal. Why? Because of capital gains treatments. If they sell the assets, while that might be favorable to the buyer, selling assets can result in ordinary income as opposed to capital gain. Whereas if you sell the stock, it's going to be capital gain, so you're going to pay less tax. Sometimes, however, an asset sale is not feasible. Sometimes your business is just set up a specific way where it's just not feasible to sell the assets. One example I can think of is if the business has a lot of contracts, maybe some contracts that can't be assigned, you might need to sell the stock so that then everything just carries over. And then, there's stock sale, there's asset sales. Sometimes you can take a hybrid approach. Keep in mind that quote-unquote hybrid approaches, these are not impacting the financial reporting side of things. These are tax only. We like to say this is where you get the best of both worlds. The seller, under specific situations, if they want to make a tax election, they can actually sell the stock, but treat that as an asset sale. Now, again, we always say that the seller generally wants the sell the stock because of capital gain treatment. Well, why would they want to treat it as an asset sale for tax purposes if that's less favorable to the seller? Well, maybe the buyer, it's more appealing to the buyer if it's structured as an asset sale for tax purposes. So making certain elections, maybe some of you have heard of a 336 or H10 election. That's where you can make that election to tax the sale as an asset sale, even though for legal purposes it is still a stock sale. So again, that appeals to the buyer more, and the seller, it will be recognized as an asset sale, so it is possible that they could have some ordinary income on that. But maybe the seller has certain tax attributes, such as in net operating loss. If they sell the stock, they're not going to be able to use that. It'll carry over to the buyer. Well, maybe you want to consider treating it as an asset sale so you can use those NOLs. That way it'll offset the otherwise unfavorable tax consequences of an asset sale. Let's talk about selling an LLC or a disregarded entity. This really depends on how the LLC or the disregarded entity is taxed for federal tax purposes. We talk in terms of selling the stock versus selling the assets. Well, when you're selling an LLC, it's a little different. You can sell the LLC units, which is similar to a stock sale, but it's also different, again, because it depends on how you're taxed for federal purposes. If you sell the LLC units and you're taxed as a partnership, it's taxed almost identically to an asset sale. A little bit different mechanics, a little bit different reporting, but for the most part, same impact as an asset sale. If you sell the LLC units and you're taxed as a corporation, well, that's just like selling the stock. So again, you can see when you sell the LLC units, you might hear people refer to that as selling the stock. Little bit different implications there. All right, so let's look specifically, the slide will go, all right. Let's look specifically at stock sales. Why does this matter to the seller? One of the biggest things, there's a single level of tax whenever you sell stock versus when you sell the assets. Think about anyone here owns Apple stock, for instance. If you sell that Apple stock, there's one level of tax at the shareholder level, whoever owns that stock. You recognize gain on your 1040. One level of tax. Generally with a stock sale, it allows the seller to walk away from unknown liabilities. Again, I'm going to probably repeat myself. Generally, it allows you to walk from unknown liabilities. It depends on the agreement. Stock sale does not change the existing contracts that the company has in place. This is why if you have unassignable contracts, you might want to sell the stock instead of those assets. A stock sale generally allows the company to continue to operate as if nothing happened. Think about, I don't know, if you watch Netflix. Maybe Netflix could sell, you would never even know because they're selling the stock. Keep in mind that the ownership of the legal entity, when you sell the stock, that transfers to the buyer in a stock sale. All right, so what about an asset sale? Remember on the last slide for a stock sale, we said there was a single level of tax. Well, for an asset sale, there's actually two levels of tax. I'll go back to my Apple stock example. If the company Apple sells assets, sells all of its assets, it's going to recognize gain. Apple will recognize the gain. The shareholder does not. All of that is taxed on the corporate return of Apple. Now, this is for a C corporation specifically. It gets a little bit different whenever it's an LLC or a partnership. The second gain, not specific to the asset sale, but when we think of how a business operates, sells its assets later, there's going to be eventually a liquidating event. First level of tax, again, is when Apple sells its assets, gain at the corporate level. The second level of tax is when the shareholder sells the stock, like we talked about in the previous example, or whenever there's a dividend out of that corporation. With an asset sale, that can result in ordinary income, so you got to be careful with that. If a C Corp, if you're selling stock of a C Corp, all capital gain. If you're selling the assets, you can have ordinary income there, especially if you have depreciable assets. While the gain on that is, to an extent, capital, you first have to recapture any previous depreciation deductions. And that's because when you took those depreciation deductions, you got an ordinary income deduction. So now whenever you have gain, the first portion of the gain has to be recaptured as ordinary income. Then anything over that is treated as capital gain. One thing to keep in mind for that one, which this kind of tricks people, you got to pay attention to what method of accounting you use for tax purposes as the seller. You can get tricked by accounts receivable there. If you're on the cash basis and you're selling the assets, you could end up selling those receivables. Say you have $1 million of receivables and $1 million of the purchase price is allocated to the receivables. You think at first maybe there's no gain. Well, if you're on the cash basis, you don't actually have basis in those, so you have to recognize $1 million of gain there, and that's all ordinary gain. With an asset sale, the seller is still on the hook for any liabilities that remained and were not assumed by the buyer. Any unrecorded liabilities are the responsibility of the seller. And again, that's not always the case. You think as a seller, if there's any unrecorded liabilities, you got to pay attention to that on the buy side as well. I know we're talking sell side, but you could purchase a piece of property. Say you purchase a building, for instance. If property taxes were not paid on that in prior years, you as the buyer could end up being liable for those, especially if the seller ends up going bankrupt. Well, who's going to pay it in that instance? In that case, the buyer would have to pay that. And then in an asset sale, as far as ownership, the seller still retains ownership of that legal entity. Remember the stock sale, the buyer retains the ownership of the legal entity. It all carries over with us. With an asset sale, once you sell those assets, you might think the business is done. Well, you as a seller still own that legal entity. You still have to liquidate later on so that you don't own that anymore. And then here's a good one. So tax returns under an asset sale, those still need to be filed until the company is formally liquidated. And this is where you really need to pay attention and understand that the sale of the assets, that's not the final sale or the final taxable event. There's still a gain or loss that has to be recognized at liquidation later on. So again, the timing of the liquidation is very important, especially if you're a partnership. So let's think of an example. We always say, when you sell those assets, you want to keep the timing of the liquidation in mind because you don't want to get, we always call it whipsawed. Still don't know if that makes sense, but that's the term we use. So there's a couple different things that can happen whenever you sell the assets. You can sell them and you can get, let's say you receive payments over the next 5 years. The purchase price is $1 million, you're going to get paid that ratably over the next 5 years. In that instance, you're selling on the installment method, so it's a little bit harder to time the liquidation the way I'm going to talk about because you can't liquidate that until all the payments have been received. But let's say you sell the assets in year one. You get the payment, you're done. So there's a huge gain whenever you sell those assets. It's important to realize that, I won't get into the details too much, but the way that basis works with partnerships, when you sell those assets at a gain, your basis as a partner is going to increase from that. It's going to decrease from any cash that is distributed to you. So again, you're going to recognize that gain, and if it's a partnership, the entity, the partnership itself isn't going to pay the tax. You as the partner will pay the tax. Your basis is going to increase by that gain. It's going to decrease a little bit. Well, it'll decrease based on the distributions, which generally aren't always the same amount as the gain increase. So your basis is going to be higher whenever those assets are sold. Depending on certain situations, there could be an instance where later on, after you recognize the gain from selling those assets, you're going to have to recognize gain or loss whenever you finally dispose of your partnership interest or when the partnership liquidates. And that gain or loss is determined on your basis. So if you're not going to receive any more cash And if you have a loss on liquidation, that's all going to be capital loss. You got to pay attention, again, to the timing of when that's liquidated. Because if you have a big gain when you sell the assets in year one, in year two, if you have a loss on the liquidation, if you don't have any other gain to offset that against, that loss could be limited to $3,000 every year. So you want to pay attention, because we run into situations where people have gotten caught with their pants down on that because they didn't know about that, and it would have saved them a ton of tax to liquidate the partnership in the year that they sold all those assets. Because again, they would have a huge gain, but they would have had a capital loss to use to offset that gain. But instead, it was just carried forward and subject to the capital loss limitations year after year. All right, so what are some other important matters related to an asset sale specifically? Tax returns are required after the transaction. Like I talked about, sell the asset, you're still going to have tax returns required to be filed after you liquidate. Those returns might be required for several years. You could have multiple state tax returns that are required to be filed. And state tax liabilities can be significant. Again, this is what I was talking about earlier when we mentioned paying attention to the distribution of the transaction cash. You have to keep these things in mind, because the company, when they sell the assets, they're still going to have to pay for these costs. Tax prep fees, state tax liabilities, and the non-resident taxes, those are what really get people you have to pay attention to. So when we, again, Mark was talking about getting a good deal team in place, working with your accountants, working with the attorneys. It's important that the accountants are brought into this process, whether it's us, whether it's a different accounting firm. Make sure you have a good deal team in place that is going to work with all the parties. There's going to be good synergies there, because you don't want to be in a situation where you think, oh, we got all this cash, all right, we're done. Let's just get it out to our investors. Because if you still have non-resident taxes, non-resident state tax liabilities, and significant tax return preparation fees, if there's not enough cash left in the company, that can be a little bit awkward to have to go back to those partners or the investors and ask for cash back to pay those, especially with non-resident taxes, because in reality, while the partnership, I'm speaking in terms of partnerships or S corporations, flow-through entities in these instances, while those aren't tax-paying entities, if there's non-resident taxes, the partnership or the S corporation is subject to those taxes. Now that is an owner-level tax, but the entity itself is required, depending on the state, to pay that on behalf of the owners. And you might say, well, why is that if it's an owner-level tax? One of the biggest reasons is because the state, they want to get their money. That's what matters to them at the end of the day. And they think that the individuals, the owners, are less likely to file in these situations, especially if they're small amounts and they're not working with a sophisticated CPA firm that doesn't understand the requirements. They want the tax to be withheld at the lowest level possible, so they know that if they require the entities themselves to withhold those on behalf of the investors, the states know they're more likely to get that tax. And that tax can be assessed at the highest individual rate. As an individual, you might have certain credits and deductions that can offset that, but that might not be the case at the owner level or at the partnership level. All right, so some important notes regarding stock versus asset sale. Again, it's kind of a reminder to re-summarize some of these things. The purchase price is going to be different. Stock sale, you're probably not going to get as much of a purchase price. An asset sale, you're going to get more because the buyer is going to have more favorable consequences on their end. The liabilities assumed can be different. With an asset sale, you can kind of pick and choose. With a stock sale, generally they'll carry over. Certain contracts, agreements, these might not transfer in an asset sale while they would in a stock sale. And with a stock sale, generally there's going to be required more due diligence, partly because you're buying the whole thing when you buy a stock sale and because of the contracts. All right, so here's a big one. Section 1202 and Section 1244. These are provisions that were put into place years ago to encourage investment in small businesses. We think this is actually overlooked more often than it should be. And this is dealing specifically with corporate taxpayers. So Section 1202, these are for gain specific on quote unquote qualified small business stock. Pay attention to these, because if you're a corporate taxpayer and you're planning to sell your business, there's a chance that you could have a significant amount of your gain excluded from federal taxes. If you look at the exclusion on here, the exclusion is limited to the greater of $10 million or 10 times your stock basis. And it's on a per issuer basis. So if you're a shareholder of corporate stock in 5 qualified small businesses, you could potentially report gain of up to $10 million on each of those, $50 million, and not pay federal tax on any of that. There are certain limitations there. The stock must be acquired at its original issue or in a tax-free transaction. You have to hold that stock for 5 periods. There's a 5-year holding period. Now, when I say corporate stock, yes, it has to be a corporate stock. But you might think, well, I'm an LLC as a partnership. I don't get the benefit of this. Well, there are ways that you can still convert to a C corporation and get the benefit of that as long as you hold it for 5 years. So even if you're an LLC, keep this in mind. And then losses on certain small business stock, similar reasoning behind these provisions, but this is to help taxpayers investing in small businesses that have losses. In this case, instead of a capital loss, you get treated as an ordinary loss, so better tax consequences there. All right, so let's talk about the sale of membership units in an LLC. Again, we talked about this a little earlier. Selling your LLC units, this is not the same as a stock sale, even though they might be used interchangeably. Oftentimes, the sale of LLC units is treated as an asset sale. So you sell those LLC units, yes, by definition, that is a capital asset, like stock, where you're going to have capital gain. While it starts off as capital gain, you have to look at the individual assets in that LLC because it's treated as an asset sale. So if I have depreciation recapture like in an asset sale, same thing when you're selling LLC units. You have to look at that and recapture that as ordinary income. Like I said, it's taxed in the same manner as the sale of the assets of a partnership. There may be some timing differences depending on when you liquidate versus when you sell those assets. But again, as far as the overall tax treatment, merely identical. With that, I'll turn it over to Dawn.
Yeah, and just one example, and this is something, and this is why it's important, and Ryan talked about it a little bit, the non-resident withholding issue. We had a transaction several years ago. At the end of the day, they had $30 million of cash to distribute to the investors, and nobody thought about we thought about the tax consequences, but the seller, they didn't think about the tax consequences. And that $30 million, for the most part, they set about $100,000 in escrow for future issues. Well, when we did the state tax returns, there was $750,000 in non-resident tax withholdings. That was a big issue. And because of that experience, that's something that we talk about all the time when we're on the sell side. We've got to make sure we're paying attention. When we're a pass-through entity, we got to make sure we're paying attention to the future tax consequences and have enough money setting aside in escrow. In that case, with $30 million, we probably should have set at least $1 million aside, and in some cases, $2 million aside for future issues, depending upon how long you think the company is going to be around. So I'm going to talk a little bit about, I only have 5 minutes left, so I'm going to talk about something that's called an F reorg. And the reason I'm throwing this in here is because probably half the deals that I've worked on over the last 5 years that are corporate deals, there's some type of reorg, generally an F reorg. And basically what an F reorg is basically just moving until the transaction happens, you do an F reorg and you're moving the money from your right pocket to your left pocket is kind of the way to describe it. So let's assume I own 100% of Cray-Merica, and I am the only shareholder in Cray-Merica. And somebody approaches me and says, hey, I want to buy Cray-Merica, but I want it to be treated as an asset deal. But currently, Cray-Merica is a C corporation. So what I could do is an F reorg. So basically, the first step to an F reorg is I form a new co. That new co I put in between DSJ, which is me, and Cray-America. And basically, once I do that, nothing happens. Nothing has changed. I still have NewCo as the filing entity, as a C corporation. Everything flows up into NewCo. By doing a statutory conversion, I can convert Cray-America to an LLC. This statutory conversion is a state law thing that wasn't even available 10 plus years ago. So something that's relatively, has come around relatively not that long ago. And basically, again, after I do this statutory conversion, Cray-America LLC, until I have a transaction, nothing has changed. I still have a consolidated group at NewCo. I file C corporation return. Cray-America is simply a division because it's a single member LLC, and nothing has changed. If Ryan decides he wants to buy Cray-America LLC, he'll come in and buy Cray-America LLC. And after this sale, I still have NewCo, which is the old company, and Ryan now owns 100% of Cray-America. Cray-America, since it's an LLC, he can tax it however he wants because he just acquired the units of that LLC. So it's a disregarded entity. He gets to treat it however he wants. It could be a corporation, a C corporation, an S corporation, or a partnership. Most times, it's going to end up being a partnership. But the reason I threw out this F reorg is because I see it all the time. And I see CFOs talking about it all the time when they're thinking about transactions. Somebody will hit them over the head and say, oh, let's just do an F reorg and we'll do this, this, and this. Yes, that's definitely available. It's available for corporate entities, and it's something that's being used quite often now because it kind of gives the best of both worlds to the buyer. So just to finalize, because I only have a minute left, transaction matters, important considerations, really important to have the right advisors. Hiring the right advisors on the legal side, the environmental side, the accounting side, the tax side, the due diligence side, the Q of E side. Having the right advisors, whether it's the buy or sell side, it's really, really important. I know we talked about that. Structuring the transaction the right way, stock sale, asset sale, something in between, stock sale treated as an asset sale, structuring the transaction the right way for tax purposes. Like Mark said, generally it doesn't matter to him whether it's a stock sale or an asset sale, but it has a significant influence on the tax consequences, whether it's a stock sale or an asset sale. And we can play and maneuver around anything there. Obviously, understanding the current and future tax issues. Ryan's comment was a very important one. Making sure you're not getting whipsawed if you're a pass-through once you sell or you close down the entity. I had a situation several years ago. It was an installment sale, and let's say in 2023, I had $1 million payment and $1 million capital gain. My final payment was in 2024. It was only $60,000. If I wait until 2024 to liquidate and I have a huge tax basis, I just got whipsawed because I have a huge tax basis and I have this huge capital loss. I'm better off not even taking that $60,000 payment, refusing to take the $60,000 payment in that example, liquidating in 2023 because I have $1 million tax deduction because I have $1 million of basis. So, thinking through that in advance is critically important. That's part of what we do. Ensure that you understand who's responsible for the liabilities. I had a client call me just earlier this week. It was either earlier this week or late last week. He said, hey, Don, remember the company I sold 8 years ago? I just got hit for $280,000 on an environmental liability that I didn't know I was still on the hook for. He sold the assets. The company assumed the liability. The company went bankrupt. So that company's gone. There's nobody around. And the next person in line was my client. He had no idea he was on the hook for this. He sold the company 8 years ago. Now he's got to write a check for $280,000. He was asking me if it's tax deductible. I said, yes, if you have the right CPA, it's tax deductible. And finally, being cognizant of the reporting requirements before and after the deal closes. You have to pay attention to the transaction document, whether it's an asset purchase agreement or stock purchase agreement. Make sure you're reading and seeing what the deadlines are, when things have to be done, because it's really important. You don't want to not be in compliance with a document that you just spent 6 months working on to get absolutely perfect. So I'm going to let John introduce our next speakers. Thank you for your time. We're all around, obviously, for the next several hours if anybody has any transaction type questions.